Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is the first webinar of the week, of the year even, of 2025. Happy New Year to everyone. And it's generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. So whilst I just let you have a look at the couple of disclaimers I need to show you, I'll just run through some of the key objectives of the webinar. Still, we think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. At the moment, what we'll do is actually address that theme currently and just run you through what we think that is and what is driving markets at the moment. It's pretty obvious that Donald Trump and his second presidency is a key theme for markets at the moment. We've seen that only this week, of course, with tariffs and the sort of headline havoc, I think, which I'll probably be using quite a lot this year, just with different stories about what policies will be, and then sort of rebuttals from Trump himself or others as to a denial of some of those stories. And we've seen that, as I say, with the Washington Post story this week, and tariffs being more sector-based, so less pronounced than initially thought. And then, of course, Donald Trump coming out and messaging that this was fake news. Markets have reacted to the initial story with a sharp selling of the dollar, but then that has gradually been reined back in. So yes, initially a key theme, of course, will be Donald Trump and tariffs and his policies. Also, interestingly, we're looking at bond yields as well, treasury yields especially, which are going higher and getting close to last year's high for the 10-year. That's the global, or the proxy for global borrowing costs, essentially. That high is at 4.73%, and we're not far off that now. So rising yields is again also another theme to do with tariffs, of course, to do with bond markets and issuance, as Scott Bessent, the Treasury Secretary-elect, if you like, is keen to raise government money from longer-term funding and the longer-term bond market, essentially the long end, and that is what is rising over the short end in sort of simple terms. Also, yeah, those are the key themes, but also our goal in the webinar is, of course, to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way or at the end, and we'll try and answer those as best we can during the webinar and also afterwards. Okay, firstly, I'll just run through quickly what we hope to get through in the next 30-40 minutes or so. We'll just check out how markets are trading currently. We'll then look at actually a sort of preview of the whole year as seen from some of the major investment banks. So that's kind of consensus on what is expected for this year. We'll just run through the different asset classes and yeah, as I say, a preview of 2025 really, so stocks, FX, gold as well. Before then getting in more immediately to this week's main event, that is of course non-farm payrolls on Friday. We'll look at a couple of graphics with the main numbers and also just check out some other US data that has come through this week already, sort of on that inflation theme actually, with yesterday's services ISM figures especially being of interest, and then we'll also check out a couple of other inflation data points which came out actually yesterday and overnight. So the Eurozone inflation data and also the Australian CPI data overnight. We'll just check out all the currencies impacted by that, so Euro dollar, Aussie dollar, and the DXY chart as well. Okay, firstly, yeah, we'll just check out how markets are trading currently. I'll check out stocks first of all, and also yeah, just the major stock indices at the moment. I'll just show you the S&P 500 chart. But generally, markets are, well, looking at that US sell-off from yesterday in equities after that stronger ISM data, as I've mentioned. Volatility did increase actually to the highest in 2 weeks, according to the VIX. That's kind of Wall Street's fear gauge, still below the long-term average, still below 20, but just something to note. Dollar has remained firm again after being boosted by that US data, that hot US data, which we had, the ISM services, as I said, and also the JOLTS data, although there are some reliability issues with that jobs data, but of course it's ahead of ADP today. Again, very unreliable really for NFP. But then, of course, we have non-farm payrolls, as I said, on Friday, the key event of the week. Metals, commodities on top really, followed by energy in quite a strong start to the year really. Just want to show you that oil chart actually, because you can just see we sort of have formed a base. If you look at it on the weekly chart, this is Brent crude. You can just see a base being formed really around the previous lows from 2023, around sort of just above 70 bucks or so in crude. And we're just sort of moving up over that now. Or sort of moving higher, sorry, I should say. Interesting whether I put a trend line in here from some of these highs and whether we're now breaking through that potentially. We just wanted to touch a couple of those high points. Depends where we go, but yes, potentially just moving higher, which is interesting for this inflation story as well. That's oil. Other currencies that have been in the news that we want to touch upon really. Dollar CAD's been in the news, of course, because of the announcement by Canadian PM Trudeau that he intends to step down after nearly a decade in power. Really sort of a sort of death by 1,000 cuts, I think the FT, Financial Times, called it, one of their reporters there. We've obviously had the cost of living crisis. We've had numerous uprisings within the party, and then also quite a few scandals as well. They've all added up really, and it's not really been down to tariffs and Trump, although the resignation of course, his finance minister just before the end of the year was really the petrol really which lighted the fire, which has brought Trudeau to step down. There's been a lot of headline havoc of course, about tariffs and Canada and the US and Trump, of course. He threatened actually only yesterday, economic force to annex Canada. But essentially a domestic election looks inevitable now, as the opposition parties will not support the new government. That is very likely, but we probably won't get an election in Canada before May or June this year. So just something to note. Yes, it was kind of the political fog cleared, but it hasn't really cleared because we may have to wait till the middle of the year now. But it is very likely that the Conservatives will gain power. Yes, even though there will be a different leader for the Trudeau party that he has governed for close to a decade now. You can just see dollar CAD did go lower, so the loonie strengthened actually, but we're now sort of back to holding on to that 21-day moving average, actually that grey line at 143.29. We're holding within this range as well, this recent range. It did look like bullish consolidation before a break higher, although it did go on for quite some time, of course, over the holiday period, let's not forget. So the breakdown did look decent, but buyers stepped in. As I say, that 21-day moving average proving to be decent support, so watch out for that 143.29, then that recent low 142.78. Otherwise, recent very long-term highs, 144.46 from last month really. And if we just go back, we can see, let's go to the monthly actually on dollar CAD. You can just see we're well up into these sort of spike levels at 146.67. and then back to 2016, 146.89. So those are sort of levels that's of resistance really around there, potentially for dollar CAD. Another currency in the news has been the Chinese renminbi. Really, that's traded very close to the critical level of 7.3750. Again, you can see that here on the monthly chart's interesting. Let's pull back the daily. The weekly chart. You can just see that level of resistance really, and we've always pulled back from there really. We're very close to it now. 737.50 on dollar CNH. It twice touched that level, as you can see, in 2022, 2023, and really all eyes again on President Trump taking office, of course, on January the 20th. Our markets really await the nature of the US-China relationship under the new administration. Interestingly, the Chinese central bank has pushed back against the weak CNH by setting the reference rate for the onshore CNY at its strongest level yet relative to where the market trades. So setting the rate below 7.19, even as spot trades above 7.33 onshore, and of course near 7.35 offshore. As I say, 737.50 is a critical level, and we'll just be watching that as well to see whether that holds or not. Otherwise, markets, stock markets essentially had a fairly strong sell-off yesterday. S&P falling 1.1%. NASDAQ actually dropped 1.9%, and the Dow outperformed, actually losing only 0.42%. The decline again followed that stronger ISM data. Renewed fears about inflation, as I've said, and raised expectations for fewer Fed rate cuts in 2025. That pushed Treasury yields higher, with the 10-year yield climbing to 4.68%. You can just see it here, actually, and I don't often look at this, but really a really important market for driving other markets as well. And you can just see that last year's high at 4.73%, as I mentioned earlier. And we're just breaking higher here, and it looks pretty, looks as though we will be getting close to that level, although just wary that we are slightly overbought. This is on yields, so yields go higher, bond prices go lower, remember. Otherwise, in stocks, if we just get back to those indices, chip stocks had got a big boost actually from Microsoft's announcement that it was planning or is planning to invest around $80 billion this year on developing data centers to train AI models and AI apps. But we had a turnaround in NVIDIA actually after it made a record high at the start of the week. The giant chip maker, that dropped over 6%, reversing those recent gains, while Tesla dropped over 4% after a downgrade from Bank of America. You can just see the S&P now, then we're just below that 21-day moving average, interestingly enough, and we've probably got support around these lows, recent lows in December, just above 6,000, always a key psychological level as well, so that makes sense. Then we've got the 21-day moving average at 58.13 otherwise, and these sort of cycle lows from, cycle lows from November at 56.96, just below that. In the NASDAQ, as I say, dropped close to 1.8%, just below the 21-day moving average now. And again, key level probably is last week's low, this year's low as well, if you like, at 20,800. Drop below there, then you've got that 100-day moving average at 20,384 potentially. But you have got this swing high from July last year at 20,690. For the Dow, interesting. I'll just put the consecutive candle count up here, which you can see. So obviously you had that consecutive days of losses through December, the early part of December, and then the big drop on the Fed meeting and the hawkish meeting. That was, I think, 10 days of consecutive losses. I haven't seen that since the 1970s, believe it or not. and now we're just tracking sort of sideways on the 21-day moving average. That's at 42,608, but just above these recent lows. So interesting whether we can hold sort of 42,146, which was that low in December. Otherwise, then we go to these swing lows at 41,647. And if we lose that, then possibly looking at the, which we haven't looked at recently, is the 200-day moving average of the black line, just below 40,900. You can see there. Okay, let's move on now to this preview that I said I'd talk you through, mainly what consensus is seeing at the moment. And if I just give you a chart here with, what different investment banks are seeing at the moment. Financial Times put together this matrix really, and you can see just the overwhelming nature of every analyst virtually expecting stocks to rise. So you've got the S&P 500, the benchmark US indices, you've got the UK FTSE 100, and then the Eurostoxx 600. Pretty much everyone expecting, everyone bullish in nature about stocks, especially in the US, and really just this sort of degree of uniformity around some of these year ahead projections. Breaking all previous records really, and just keeps us on watch, with consensus being so strongly in favor of one direction. If we just look at stocks at the firstly, then of course the S&P surged over 20% last year. That notched up to a two-year jump actually of around 53%, and that's its strongest back-to-back annual performance since 1998. But of course, always warning signs, even though there were warning signs at the start of last year. We blew those out of the water in the US especially. But for equity markets then, most banks consensus really expect the S&P to reach fresh highs again this year. Most believe the performance, if we just look at some of these names, all the different banks here, and the average is expected to be around 12% or so, so just above the historical annual average. Most banks expect at least a 10% climb, generally to around sort of 65.50 or so. One bank expects, I'm just checking that actually, which isn't on this list, but if we look at here, a few banks three banks actually, expect the S&P to finish the end of this year around 7,000 and above actually in the S&P. That is generally down to they cite the persistent strength of the US economy, of course, although of course it said, or generally those banks think the timing of potential shifts in policy under Trump will be key to how markets perform. Otherwise, though, the rally will be driven by, of course, investors' huge appetite for artificial intelligence stocks, which will persist even though valuations are unambiguously high. And also the breadth, just to mention that again, but the breadth in some of these wider S&P markets is again very, very narrow, and really these indices are being driven by literally a handful of stocks, again less even the Mag 7, of course, coming into its own again, probably along with Broadcom. So that's a name to remember with the Mag 7, but literally a handful of stocks driving these wider indices higher. Just one caveat to sort of the tech situation. Some analysts, of course, are waiting for signs that technology will lead to a revenue uplift for companies. And there are really examples of investor exuberance that could mean a more negative outcome in 2025 this year. And certainly, again, there is a lot of uncertainty over Trump's policies, which could potentially weigh on stocks going forward. Just touching upon European stocks, most banks you can see expect those to rise apart from one. There are tailwinds if the ECB cuts rates more quickly than expected. Of course, if the war ends in Ukraine, that would bring massive upside potentially, you would think. And then also if the political situations in France and Germany start to stabilize. Yeah, only one bank is bearish actually, which is UBS, really, and they're expecting the market to turn negative in 2025, but everybody else really doesn't think that will be the case. I just want to touch on FX now. More than half of the banks surveyed expect Trump's policies to drive the dollar even higher in this year, despite the president-elect raising concerns about what this means for America's competitiveness against its trading partners, of course. Several banks, they expect the dollar to reach parity against the euro. That, of course, the single currency experienced the largest decline of any G10 currency in the immediate aftermath of November's US presidential election. And we'll look at the euro, of course, shortly. Trump's preference for tariffs as a policy measure, of course, helped to lift the dollar. And the policy mix of tariff hikes and tax cuts are expected to lend significant support to the dollar over this year. Interestingly, some do expect the greenback to strengthen in early part of this year, but then weaken back to say 110 or so in euro dollar by the end of the year, really because Trump's rhetoric is translated into hard policy by then, and the market at the moment has been responding to expectations really of a perfect storm of tariffs rather than what will be implemented. Of course, we know tariffs are coming, but we don't really know what they'll be, and that is in Trump's court, of course. Gold as well, just to touch upon that, and I'll bring up the chart shortly. You can see overwhelming consensus again that gold goes higher this year. Of course, it enjoyed a record-breaking rally last year, supported by the Fed's easing cycle, big central bank purchases, and we know China buying gold again recently, as well as, of course, the safe haven demand. Heightened geopolitical and economic risks have really helped to push prices, to an all-time high at 27.90 in late October. And several analysts do fear or expect demand actually from central banks, of course, and also there are fears of inflation and also fiscal profligacy, which could be driving forces, of course, going forward. Interesting, Goldman Sachs, just to note them, they expected gold to climb actually, nearly 13% to $3,000 an ounce. Great headline that. That would, though, be less than half the gain seen this year. But interestingly, just in the last few days, they have pushed out that forecast to mid 2026, so next year, really on the back of less Fed rate cuts. I think the average, though, is generally expecting the average bank, so consensus expecting a rise of around 8% in gold. That would take it to 28.60 or so. Yeah, let's just pull up a gold chart actually, just to check it out at the moment. Here we can see just quite a little bit sideways trading, really. We're supported by the 21-day moving average again, 26.28 that is. If we do hold above here, then we have a minor fib level around 26.69, and then we've got these highs which are resistance around 27.20 or so. Before then, the all-time high, of course, at 27.90. Support, probably this fib level here is nice, 38.2 of this move higher. That's at 25.94, and then we've got the halfway point of this move, which tallies with that swing low from mid-November around 25.33. Okay, let's move on to this week's main event now. That's a little preview really of this year and what's to come and what consensus sees. But if we now move on to a preview of this week's main event, which is of course the US jobs report on Friday. Consensus currently expects around, the US economy to have added around 160,000 non-farm payrolls in December. That is against the 227,000 printing in November, with the unemployment rate unchanged at 4.2%. Really, we're expecting to see the December data show payrolls normalizing really after the previous couple of months, which reflected really weather and industrial action disruptions. Of course, we saw the rebound in November, 227 after the much lower figure the month before. A rise of 160 would bring total 2024 job creation to around 2.144 million, I think, which is kind of solid, but would actually be the lowest annual total outside of the COVID-driven loss in 2020 since actually 2019's number of total job gains of 1.988 million. That's for your guide of the last year's total job creation, because of course this is December's data. Regarding this report then, and just looking at other labour market proxies, they've been relatively mixed really. Survey indicators really showing mixed signals on labour demand. The 2025 and hiring rates has slowed below pre-pandemic levels, and job openings have normalised, but then both the weighted average ISM employment index and the NFIB hiring intentions indicators have picked up at the end of last year. Going forward, the FOMC's latest December projections, of course, they saw the jobless rate rising to 4.3% this year, where it's expected to remain throughout the committee's forecast horizon before settling around actually 4.2% in the long term. We should note, though, Fed officials, of course, have premised their views on different assumptions regarding the policies of the incoming Trump administration, and that really does suggest that as new policies are enacted, then the Fed's view is likely to change in the months ahead, and that is a key sort of takeaway really from a lot of banks as well, investment bank strategists really saying how volatile potentially forecasts will be and will have to change on a much shorter time frame. Wage growth, average hourly earnings, they are expected to rise 0.3%. That's down a tenth from the previous 0.4, and the annual rate is seen remaining at 4%. Interestingly, that 0.4 pickup really in November surprised to the upside, and really markets will be watching to see if this sort of continues or normalizes, because of course any above consensus wage metric could fuel again concerns about accelerating pay growth, which would then of course limit the Fed's scope to continue any sort of rate cuts. And interesting, of course, Fed officials have argued recently actually that the current labour market was not a source of inflation pressures, so eyes on that number as well. Overall, cooling labour market is expected really, and after 100 basis points of Fed rate cuts last year, that is probably what the Fed was likely factoring in when it revised its dot plot, of course, in December to only 2 cuts in 2025 this year, and that really means it should be supportive for the dollar. Of course, if we get a blowout report or a much stronger report than expected, then that will boost the dollar and take it to its recent highs and probably above. Stocks may be affected if we see rate cuts reined in even more, and other currencies will suffer against the dollar, of course. If we just look now at the DXY chart, which is obviously the dollar against 6 of its major trading partners, we can see just this sell off and now pick up again. Didn't quite touch the 21-day moving average at 107.83, but it really looks as though we are going to challenge that recent high. That's at 109.53. If we just pull it back Where would be the next levels? Possibly 108.30, 110, sorry, 78, 110 the round figure potentially if we can get above that. We are overbought now on the weekly. On the weekly, sorry, not overbought on the daily because of this pullback, which was healthy. But of course, much will depend on non-farm payrolls. A weak report, of course, would affect the dollar, and we would see some selling in that, and it may help stocks again just to push higher. Also of note, actually, just want to mention some other US data. It was that ISM services that I talked about at the top of the webinar. That non-manufacturing ISM rose to 54.1 for 52.1 in November. The expected was 53.3. Well, services activity really is doing well for the economy. Of course, it's remained in expansionary territory since July of last year. And really noticeable in this report was the prices paid subcomponent, which soared, actually spiked to 64.4 from 58.2. That was its highest level since January 2023. And again, this sort of highlights that theme that I talked about at the top of the webinar about inflation and a possible inflation resurgence. Definitely worth watching for that going forward. We also have the Fed minutes out overnight, later on today. That was for the minutes for the December meeting, of course, where the Fed cut rates by 25 basis points as expected, but then of course it communicated that hawkish twist with a shallower path for rate cuts going forward. Really any chatter around what they called a sort of new phase of monetary policy will be key. So any strength of the pushback versus rate cuts, and then of course the Fed's reaction function to rate cuts going forward will be scrutinized by markets this evening UK time. Also, we had some important European inflation data that came out yesterday, and in line actually, really. So the headline number picked up to 2.4 from 2.2%, really down to higher energy and food inflation, base effects of those, while the key core number that also printed in line, staying steady at quite a stubborn level of 2.7%. That means, of course, that inflation has undershot the baseline forecast in the ECB's December staff projections, slightly in Q4, really by 0.1%, both for the headline and the core. That means it really sort of bolsters the case for further easing. So even though we've had a tick up, fully expected by the ECB, and as I say, a touch lower than their forecasts even. So yeah, shouldn't hold back on any rate cut by the ECB, which will be at their January meeting on at the end of the month, actually in the last week of the month. The Fed is just the day before the ECB meeting on the 30th. There's around, I think, fully priced in for the January meeting, and then around 4 rate cuts of 25 basis points across the year this year. If we just look at euro dollar then. Which is here and is suffering today. We got up to this strong resistance zone, we were calling it really, 104.48 key level from a low from October 2023. Also the 21-day moving average was capping the upside as well. You can see that now at 104.12, and really it was just an opportunity for sellers to pile in and hit the euro against the dollar, and prices are now moving lower again. Key level obviously is the recent cycle low from last week at 102.22, but as I say, a lot of strategists, not consensus really, but a lot of strategists expecting parity, which is of course this big dotted line here. That's in Eurodollar. Otherwise, one final thing to look at was the Australian CPI data out overnight. That reported the headline to have risen 2.3% from 2.1% in October, mainly due to timing of electricity rebates. Excluding volatile items and holiday travel, actually, CPI rose 2.8% compared to 2.4% previously. Again, mainly driven by changes in electricity prices. The annual trimmed mean inflation, that was at 3.2% now. In November, actually down from 3.5% in October. That is the important pointer in the RBA's inflation assessment, and we note it is moving closer to the RBA's 2 to 3% inflation target. The RBA, just checking that the first policy meeting is in mid-February, 17th to the 18th, and really after holding its policy unchanged at 4.35% since November 2023, markets now see a pretty high chance, around 75% of a first 25 basis point rate cut in February. Aussie, of course, has suffered. You can see the weekly chart here, and just multiple weeks of selling after sort of printing at a high of 69.42 on the daily. You can see that here, really a nice sort of bearish channel, a series of lower lows and lower highs, really, and now we're threatening that recent low at 61.78. And also then the very long-term low, which is at 61.69 here. That goes back to October 2022. If we pull up the weekly, actually, if we do lose that, then yeah, there's not a great deal of support really now to probably big psychological figures like 61 and then 60. Okay, we will wrap it up there. Really great to have you all on the call. Really do appreciate you sticking around and listening to what we have to say. Nice preview, we think, of what's happening or what people think. The main consensus thinks anyway for this year, and then obviously a look at non-farm payrolls. Should be interesting, exciting year ahead for sure, week ahead as well with that US employment data. We will speak to you in a couple of weeks. Take care, and yes, good luck out there.